My name is Caleb Jennings with the Cams Jennings Group at Guaranteed Rate. And John Cams is going to be leading us in the discussion today on the rate and housing forecast. He's our team lead. One thing I just want to say is that we moved to Guaranteed Rate at the end of last year, and it's the best move we've ever made in the mortgage industry. We're super excited about it. Guaranteed Rate offers awesome products and services for our clients and for you that are just like the best in the industry. We are super excited about that. You know, first-time home buyers are going to be huge this year. Don't be shy about the first-time home buyers. You're going to want them. And we have some amazing products to help them be able to get into their home. So I really want to encourage you to get first-time home buyers to us. There's some awesome grants and programs that we can help benefit them that are the best in the industry. In fact, we have a grant that Guaranteed Rate is doing, no other lender is doing. So if you want more about that, let us know after this. But without further ado, I'd like to turn it over to John Cams.
Hey, everybody.
Go ahead, John.
I'm John. Thanks so much for joining us. We're really excited about 2023 and our change over to here, but we're also just excited that you guys and honored that you would come and join us here. So thank you so much. So 2023 rate and housing forecast. Let's go ahead and get started. So I know that a lot of you guys are on my text feed, and and this has been kind of hammered, but mortgage interest rates are very affected by inflation. They pretty much move in tandem with inflation. And the reason why is because as the price of goods goes up, a mortgage only can yield a typical 30-year fixed mortgage can only yield what the interest rate is. So a 6% mortgage interest rate can never yield more than 6%. So as prices of goods go up, the investor, the buying power of that 6% erodes. And the only solution they have is to raise interest rates. So if you look here, this is basically a comparison. In the blue is the 30-year fixed mortgage interest rate from 2018, and then this maroon is the core price index, or the CPI, or core consumer price index. And what this is showing is that if you notice, as inflation goes up, rates go up. Inflation goes up, and they're not in tandem, but pretty close, okay? And if you get to here, what happened is you had basically the Fed come in. The Fed doesn't necessarily influence interest rates, at least not mortgage interest rates, with the Fed funds rate that they use, but they can influence interest rates by buying mortgage bonds, and that's what they had been doing through the whole pandemic. So if you notice here, the Fed was buying mortgage bonds to drive interest rates low, and you saw inflation tick up here. Mortgage rates should have moved up with them, but the Fed was basically buying mortgage bonds to keep rates low, near 3%. And if you look, they were late to the game. This was basically when they were telling us it was transitory. And then if you see mortgage rates, inflation continued to move up, and the Fed, it was a double-edged sword where the Fed stopped buying mortgage bonds and inflation was through the roof. And so you see what happens is mortgage rates skyrocketed. But you see here, inflation has started to come down. And again, you see mortgage rates start to come down in step with that. So when will inflation peak? Well, what's really interesting about this is that currently, this is what they call the core consumer price index. And there's a lot of different ways that the Fed measures inflation. But what this does is this takes out food and energy costs, which the Fed views as they can't really control the cost of oil if there's a crisis like the Ukraine war or things of that nature. So this is basically a more stripped down version of inflation. And that was at 6% year over year. And if you notice, what's happening is that we're replacing the numbers of last year. It's a trailing average. So this number, by the way, that came out in December, because it came out the first week in January, was 0.3. So if you look here, the numbers that this is replacing, we see that inflation basically coming down, because what's happening is you have basically, it's going to replace a 0.6 here, which is going to help the trailing average. in January when we get this in the second week of February. Even if it's a 0.3 or a 0.2, it's going to be a lot lower. February, we're replacing a 0.5, which is going to be even more. Sure, inflation may tick up a little bit in March because it's replacing a 0.3 in the core CPI, but look what happens in April, May, and June. So we think inflation is going to continue to come down, which is going to put downward pressure on interest rates, which is going to obviously bode well for the housing market. And I think what's important to note in inflation is shelter costs and how they're lagging. So this core CPI that I had mentioned, 39%, 39.3 to be exact, of this component is shelter costs. And if you notice, shelter costs have come down. Okay, but what the way the CPI is figured is that they use an average of the year. So this is where we are right now. And this is where rents and shelter costs peaked. So if you look here, this is the 12-month average. This is the number they use. So what's going to happen is that once this catches up, it's a lagging indicator, because this is the whole year. It takes people time to move out, their leases got to expire, et cetera. So as shelter costs come down, which is a 39.3% of CPI, which is already starting to come down, it's just more signs that inflation is going to continue to come down, as well as mortgage interest rates. I think this is a good metaphor here of what we're trying to explain here, is that it's a lot like a roller coaster. If you notice, right here is where we're at. This the shelter costs that we saw back there of 4 point something. This is what's being reflected today. And this is basically, so you notice we're coming down here in reality, but we're still lagging here, if that makes sense. So in January, we see this peaking, and then we see shelter costs coming down dramatically, which again is going to really help CPI and just points to more signs that inflation is coming down, which rates are going to come down in step with, and buyer competitiveness in the market is going to continue to increase. So what this basically is saying here is that not only is shelter coming down, but undoubtedly prices have come down across the board for food, gas, clothing. All these are reflected in the CPI, but the shelter costs, 39% of that, although decelerating, are still showing increases due to the lag effect. So we really see March, April, May, June, when this starts to catch up, interest rates continuing to fall because inflation coming down. The other thing we have going on here, which is really fascinating, is that this is basically the spread between, if I went to go buy a 10-year treasury, which is the safest investment, I go and say, hey, I'm going to go give the government money for 10 years. The government's never defaulted on a loan. The 10-year treasury is what that's referred to as and the spread between that and a 30-year fixed mortgage rate. So historically, the spread between these is 175 to 200 basis points, also known as 1.75% to 2% higher. So if you look here, the 10-year was around 4%, mortgage rates were 6%. That's the spread. So a 200 basis point difference. And this is for 35 years. What's happened in just the last year is this spread has increased to 300 basis points. So you have right now the 10 years at 3.5%, or when we made this slide, the 10-year was at 4%, mortgage rates were at 7%. Why is that? Like, what changed over 35 years to make this happen? And the answer is that one of the intrinsic values of a mortgage is the servicing value. So when somebody gets a mortgage for 30 years, that mortgage is sold on a secondary market. Sure, you're making your payment to a lender, but all mortgages are sold, and that lender gets paid a servicing fee to basically service your loan. They have to take your payments. They have to answer your questions. They have to manage your escrow account. That fee is built into this loan. And the longer the servicing period is, the more they get paid. The more they get paid, the higher the value of the mortgage, which drives down the interest rate. Well, what's happened in this market is that you have rates going up so fast, and you have the smart money believes like us that rates are going to come down. So now all of a sudden the servicing value of that mortgage has severely decreased, because they're like, well, if the loan's going to be refinanced in 6 months to a year anyway, we don't have any servicing value. But as rates come down, and you've already started to see this, the spread between these two is starting to tighten, as you can see here. So it's just more downward pressure on interest rates. As interest rates get into the fives, servicing value goes up, which puts even more downward pressure on the interest rates. As the 10-year gets to 3%, like we're predicting it's going to be, we're going to see that the normal spread between these two is going to be back to normal, which is going to be interest rates in the fives. And this is just exemplifying here that the spreads tend to move a lock in step with, as rates go down, the spreads, it accelerates the drop of rates. This is the other thing, recession, more downward pressure on interest rates. A recession is coming, and the problem with the recession is it's the International Bureau of Economic Research or something like that determines whether or not we're in a recession. And oftentimes they determine that we're in a recession, that we were in a recession when we're already out of it. They'll say, hey, a year ago you were in a recession. So we may already be in a recession. However, just signs that you can tell your clients that, hey, even though the jobs reports are coming better than expected, is what I've seen the media really grab onto to say that, oh, we're going to avoid a recession, there's going to be a soft landing, is credit card debt and other revolving debt. If you look, this is basically credit card debt since the pandemic has skyrocketed. If you look here, this is savings. So savings have plummeted. This is basically the first stimulus here, a bump in savings. Here's the second stimulus, another bump in savings. Here's where we are today. So you have people basically not changing their lifestyle and living off of their credit cards and their savings, which has an expiration date, which leads to obviously a recession, a slowdown in the economy. All the signs are here. And the other big sign is basically what they call an inverted yield curve. So if I were to give you money for 10 years versus 3 months, I should get a higher interest rate on loaning you money for 10 years versus 3 months, which is intuitively true. But right now, when you do the math on the spread between the 10-year treasury and the 3-month treasury, which is basically, again, government debt, you're just borrowing to the government for less of a time, you actually get less of a return over a 10-year period than you do over a 3-month period. And if you look here, this is basically every recession since the spread. This is if the 10-year and the 3-month were exactly even. Every time we've gone below a recession, go below, recession, go below, recession. Here, recession. Here we are. Look at how far the spread is between the 10-year and the 3-month, which again points that we are, if not already in a recession, going to be having one. Now, I think obviously we should talk about demand, which we know is going to remain strong. So interest rates have gone up to the highest rates in 20 years last year. And if you notice household formations, if you look here at the height of the PEM, or May of 2022, household formations are basically new houses formed. So I move out of my mom and dad's home, I need a new home. So what you've noticed is that they've come down. Why? Because interest rates have gone up so much that it's killed people wanting to move. They're hibernating, they're waiting. So now let's talk about, so we have basically 1.3 million household formations. So we know in a hibernating environment, we're at 1.3, where rates are the highest that they've been in 20 years. Houses completed. So we basically as far as inventory comes into play, approximately there's been 1.5 million homes completed. But what you have to take out is that you had to replace about 100,000 homes. So that means that the total supply is 1.4 million homes right now. And we have 1.3 million household formations in the face of the highest interest rates we've had in 20 years. Builders have learned their lesson. They're much more cautious than as they were in 2006 to 2009, and they've slowed down. And then not only that, you hear the media, house price moderation. There's hardly a crash. Okay. If you look at the last 10 years, we are up 115% in housing. We're up 39% in the last 2 years. In the face of the highest interest rates in 20 years, where housing is down 2.5%. I think this is a great slide to show to a lot of our buyers. I think affordability is another thing that needs to be addressed. So what you see here is basically, hey, if you were to buy a home for $400,000 at 3.5%, the monthly payment is $1,796. If you were to buy this, we know that there's been 10% appreciation this year. So today you have to buy that same home for $440,000, but the interest rate is 6.25%. So that's $2,709, and your payment just went up $913. But what is never necessarily explained to people or thought of is that incomes have gone up as well. So if you look at last year, the average Fannie Mae, Freddie Mac say that the average person, the average income of a $400,000 home is $9,000. Okay, so this same home, what people, ADP puts out a report every month, and it tells you what wages have done. It does 25 million workers, and it says that the average person who stayed at their job had a 7.6% increase in wages. Somebody who switched increased by 15.1%. So obviously more people stayed than switched. So let's just take the average, 9%. So sure, the interest rates are higher, prices have gone up, but so have wages. So when you take that into account, they got $810. They're getting paid $810 more. But the thing that we got to take into account, though, obviously everything else has gone up as well. So gasoline's gone up, food's gone up, services have gone up. Now all of a sudden, they've actually gone up $1,154, and their wages have not caught up. However, let's just say that heading into next year, when these numbers come out, and let's just say that we only receive a 5% increase on this 9810. Well, now they can cover it. And when you look at this, ironically, when you factor in what if interest rates go down to 5% like we thought, well, now they're making $1,300 more, and the payment only went up $807. So ironically, housing affordability, if the rates go down to 5% and you take into account the fact that people are making more, is actually more affordable. If these numbers shake out, will be more affordable than in the pandemic. And buyers and people need to know this. So what is our forecast? We forecast lower inflation, recession-like slowdown, incomes increasing to help for affordability, very tight inventory environment. And then I think one thing I forgot to mention here is that when you really analyze this, rents are still expensive and rising. It's very unattractive to rent right now, which is going to continue to help as rates go down. It's going to continue to help demand. We see low single-digit appreciation for most of the U.S. with a pickup in activity. I don't know if you guys have felt it, but we are definitely busier. The stats are, I think, purchase applications are up 25%. Because rates are the lowest they've been in about 6 months, 4 to 6 months. So what are some of the headwinds? Well, obviously, global quantitative tightening. Banks across the globe are tightening their belt and not wanting to and trying to fight inflation. However, Canada actually just came out and said that they're going to be pumping the brakes because they feel like they want to see what the effects of these rate increases are going to do. So hopefully our Fed can follow suit and the not overdo it here. There's already a lack of foreign central bank buying. We know that because of this tightening easing, and then more debt to be financed are some of the headwinds. Tailwinds, we got lower inflation, excess retail inventory, increase in mortgaging service value, like we talked about, and a recession likely and rates declining during recessions. So all in all, we're very optimistic. We're very excited for the housing market. We feel like we're past the worst, which of a slowdown that was actually needed. And we predict 30-year fixed mortgage rates move near 5% during the first half of 2023, and that U.S. 10-year Treasury coming down to about 3%. So that is the presentation. We can go ahead and open it up for questions. We thank you guys so much. And
yeah, so can you hear me, John?
Yeah, I can hear you.
Awesome. Yeah. So I want to thank everyone for joining us. I think we got 30 participants on here, which is awesome. And the fact is that John alluded to, we're getting a lot more folks applying right now to get pre-approved, which is great. And right now is a great time to buy. We are in this kind of perfect storm. If you have buyers that are on the fence that can afford to buy right now, it is a great time to get in the market, because I'm sure, as you know, sellers are much more giving right now than they've been in a while. But we're predicting, though, come spring, summer, when rates are start to drop back down, there's going to be this influx of buyers again, and we're going to get really back to that multiple bid situation. So if you're a buyer, now is such a great time to take advantage of the moment. And the other thing I want to share with y'all, which I think is really critical in this point too, and we're really excited about, is that with Guaranteed Rate right now, with our clients that buy now, we're going to be able to give them a no fee refi later. And Guaranteed Rate is putting together a program. We're actually going to have some information on that, like marketing materials. But so if you have a client that buys now, gets in the market now when it's less competitive, gets their home, then we'll refinance them with no lender fee later, which will be a great deal for them too. So I see we have a question here. John, I'm going to read the question here. What did you mean by builders learned their lesson in 2006 and 2009? Can you expound on that?
Yeah, in 2006 through 2009, builders just were like, we're ignoring all signs. We're foot on the gas, build. And that hasn't been the case. Obviously, we've had, because of COVID, building was already, has already been, what's the word I'm looking for? Depressed. But obviously with rates going up, builders have pulled back, where in 2006, 2009, they didn't. And that's why you saw, I can't remember the figures, but the inventory was like twice as much during the 2008 crash than we have right now.
Are there other questions? You could drop them in the chat. Here's another one. Do you feel the 10-year price increase is sustainable? That's a big number.
The 10%.
Do you feel the 10 yearly price increase?
No, I don't. That's why we're saying we expect single digit appreciation. I don't think that's sustainable, but it was, if that's the question. But I do think that you're going to see, it's still a great time to buy. Like, even if you do like an investment calculator with a house, even 2, 3, 5% appreciation is a huge proponent to wealth building. And I do think you're going to see over an average single digit, more normal appreciation. Ideally, or is what I think, but it wouldn't surprise me if we see higher. I think housing is actually, the facts are there's just so much demand and so little supply, and there's no really solution to that. I think that, think about how busy we are right now, and rates are at, call it 6 to 6.5. If we get to like 5%, not 5.9, not 5.75, if we get to 5.25, 5, I think we're going to be just as busy as we were in COVID.
John, that's a good segue. We got a question. What do you think the new normal will look like once the interest rates come down? What will be the new normal on rate?
I would say if we're low to mid fives, and if we're lucky, fours.
Yeah,
we have a lot of stuff coming up that, like, I think you factor in the fact that we're going to have a recession. Like I said, the servicing value of these loans is going to continue to go up. Inflation's already coming down. I think that I hope that answers the question.
And then there's the other question about 30-year versus 15-year. Typically, what we advise our clients on a 30-year versus 15-year, we'll give them their options. But what we let our clients know is that if you get a 30-year fixed, you can still make a payment that is equal to a 15-year, but you have that flexibility where if you ever fall on some hard times, because the 15-year payment is obviously basically double, it's a higher payment. So we advise our clients, the safe bet is to go 30-year, but you could still pay it down in 15 years. But we let them look at the numbers and decide for themselves.
And I do think I know I take a more of an advisor role and with our buyers, and I'm always going to tell a buyer, I would much rather take that money that I'm going to put towards a 15-year mortgage and put it in my 401k. And most buyers are not maxing out their 401k. You can sound like an expert when you tell them that. Why would you pay down a 15-year mortgage when you're not maxing out I think it's $21,500 of tax deferred investing you can do for your retirement? Why would you go to a 15-year fixed mortgage? I would much rather do a 30-year mortgage. On average, I think it's $700 to go to a 15-year mortgage. I think it makes much more prudent financial sense to take that $700, make it $1,000, and put it in your 401k. But ultimately, we give the client the options and let them decide. So that's what I would recommend to buyers. The thing I know about doing this a long time is people that want to do a 15-year mortgage really want to do a 15-year mortgage. So be careful.
So there is a question about what does the rate have to reduce to in order to make sense for a refi? You offer the no fee refi, but it has to drop how much to move forward with a refi? I mean, it really depends on the numbers. The loan amount can have a big impact on that too. Like an eighth of a point on a $700,000 loan is much more money than an eighth of a point on a $150,000 loan. So I think it really just comes down to what their all-in monthly mortgage payment is, and if it makes sense, if they're going to save good money on their payment.
And I just to play devil's advocate, ultimately, and I've used this with borrowers before, is that if we're covering all the costs and you're truly not paying anything, why wouldn't, if I can even lower you an eighth of a point, why wouldn't you? But you get into like, some people don't want to act right away on that, but ultimately, like, hey, if you're not paying anything and I told you can pay less on your monthly payment, wouldn't you do it?
Yeah, no.
I mean, it's I know that's I mean, it is a great argument. So
great. Any other questions related to the presentation? Awesome. Well, we're gonna get a copy of this out to y'all too. We're recording it. We're gonna share that. And ultimately, you know, our business is 100% referral based, just like yours. We have an awesome team. John and I have a team line. We answer our phone 7 days a week. We're never too busy for your pre-approvals. We're really loving all the products and services we do have here at Guaranteed Rate, but ultimately our team is really good. We know what we're doing. We're here to help. I don't know if you have anything to add, John, before we conclude.
I think, just anybody you have, you can text us 24/7, 402-882-5626. And our team email goes to everybody. It's K as in Kelly, J as in John, G as in group @rate.com. So hit us up if you guys ever need anything. We're excited to work with you, and we're really excited about 2023.
Awesome. Thank you. Y'all have a great day.
Thank you.